Hey everyone, welcome back to another video. In this lecture, we're going to be covering options. So here's a little overview over options. So options are financial instruments that depend on the value of other underlying securities. So that makes them derivatives. And let's take an example. So if we had a stock option, these options would depend on the value of the stocks that they correspond to. So that would make the stocks the underlying securities. And with options, holders can either buy or sell the underlying securities. And they don't have to, but they just have the right to do so. And each share of an option is sold at what we call a premium. And in this lecture, we're just going to be talking about stock options. So there are two different types of options. So there's a call option and a put option. And in a call option, you're basically making an agreement to buy an asset at a specific price at a certain time. And put is similar, except instead of buying the asset, you have the right to sell the asset at that specific time and at that specific price. So here's how puts work. So the holder is given the option to sell, like I mentioned in the previous slide, a bundle of stocks at a specific price. And that specific price is called the strike price. And the way you make money on puts is if your strike price is above the stock price. And it's essentially just a more complicated version of a short position. And for those of you guys that don't know, shorting is when the investor is betting on the stock price falling and they profit off that dip in price. So here's how calls work. So instead of having the option to sell a bundle of stocks, they have the option to buy stocks. And in order to make profits with calls, the strike price has to be below the stock price. So think of it this way. It's like buying a product at a discounted price and then reselling it at its regular retail price. It's the same thing, except we're dealing with stocks instead of your typical product. So here's a little bit more information. So bullish means that people expect security prices to rise. So if I'm bullish, I'm expecting the security price to rise. And if I'm bearish, I'm expecting the security price to fall. So in a call, you're basically a bullish buyer, but you're also a bearish seller. And in a put, you're a bearish buyer, but a bullish seller. So that's it for this video. Thank you guys so much for tuning in, and I'll see you in the next one.